Hello and welcome to the DIY Investing YouTube channel. We are working through every company in S&P 500, and today is Equifax Incorporated, ticker EFX. Over the next few minutes, I'll discuss my thoughts about both valuation of this company and its business quality. First up, we have a market cap of $24 billion, enterprise value of $28.7 billion. So you see about $4.5 billion of net debt on this business. That's about 20 to 25% of the total enterprise value. So it's a decent amount of debt. It's in the professional services industry. And it's, let's look at the business description here. So they have information solutions and HR, business process automation outsourcing. So they have three segments: workforce solutions, U.S. information solutions, and international. Workforce solutions offers employment, income, criminal history, social security number verification services, payroll-based transaction, employment tax management, identity theft protection products. So it's interesting. I mean, when I think of Equifax, I'm thinking of just, the credit bureau. But it's clearly they have a lot of other segments here in what they're doing, selling those services beyond just the consumer segments. They provide consumer and commercial information services. So you have that credit information. You also have credit scoring, modeling, portfolio analytics, quite a few number of different things. While the international segment offers this basically similar suite of products. Looks like they're in quite a few different countries around the world, but I would presume a large portion of their business comes from the United States. Now, beta 1.48 means they're about 50% more volatile than the average S&P 500. So that tends to be, a sign of a relatively lower quality company. But we'll see if the rest of their charts play that out. When I first look at this return on invested capital chart, though, it looks quite the opposite. This looks like a high quality business. I mean, on an instant basis, we see that they've only lost money in 1 year out of the last 20 years, and that was 2019. Because 2019 had higher revenue than the previous year, I'm instantly starting to think that this number isn't an accurate assessment of their business. They did grow their revenue year over year that year, and they just had a massive drop in EPS. So this tends to make me think something weird is happening on the operating profit line. Something happened on their costs. But, I think Equifax had one of those data breaches. This might be the year of the data breach. And again, that's one of the risks with some of these online data companies is that you're going to have a data breach. And if that's the case, then that would explain this 1 year of loss. That's probably pretty normal to expect maybe a year of losses out of the last 20 years, and that's a really good result for shareholders. If you're profitable 19 out of 20 years, you're going to have a really good business. It's going to be hard to lose money as a shareholder. Now, the other thing that I really like about this return on invested capital chart is how stable it is from year to year. Not a lot of companies that I cover have this sort of stability where I can really touch on it, but you can really see it here. I mean, of course, you had really good returns 2002 to 2007, these 16, 14, these kind of teens returns. But if we simply look from 2008 to 2017, you had a 10-year period where there was very little change year over year in return on invested capital. 10%, 8%. 9.6, 8.5, 8.4, 9.3, 9.6, 11.6. These are very predictable numbers. There's absolutely no cyclicality here. And anytime you have no cyclicality, I start to think, hey, this is a better business than I would expect. And so you like to see those numbers. Now, you did have a turn down in 2018 and 2019. And again, I'm expecting maybe this is sort of that data breach stuff, maybe some excess costs that they had to pay. But we can dive on into those financials a little better. Also, the fact that this is hovering around 10% and then they add some debt on that makes this a really attractive kind of number. I like it when you're covering around that 10% number for return on invested capital. And as we can see with these 10-year median returns over here, is they're really able to catapult that 9.2% return on invested capital up to a 17% return on equity. This is a really good balance. I mean, typically I like 10% here and then 15% here, but I'll take 9 and 17. This is really good numbers. I would definitely qualify that as high quality business numbers. And if you can combine that with growth like we're seeing here, then this becomes really, really attractive as a potential business to buy. You're seeing very strong margins as well. 63% gross margins. Anytime you're over 50%, that's quite attractive because you can get these really nice conversions of free cash flow. 23% EBIT, 21% pre-tax, and 19% free cash flow margins. Very, very strong margins. That provides them from protection from, rising costs and other things like that. So it's a very strong setup here. Good return on capital, good margins, and very nice growth. You see these double-digit growth numbers. I like that the revenue is growing right in line with free cash flow. 10%, 10%, 12% EPS, 12% assets. All of these are very strong numbers. They're in the double digits, but there's also nothing out of line. Although assets is growing slightly higher than revenue, it's growing just in line with EPS, so there's nothing concerned there. And it looks really good from an overall growth. Anytime you're growing at a double-digit rate with these high rates of returns, you're going to likely get set up for double-digit returns as a shareholder, and that's really attractive. So everything I'm seeing here, high-quality company, non-cyclical, very strong returns on invested capital, strong margins, strong growth. The only concern that I start to see here becomes valuation. When we look at the valuation ratio, we see a valuation of 34 at the PE, and that's combined with the price to sales of 4.7 and price to book of 6.4. What this tells us is that the PE ratio is not off due to some sort of one-time adjustment. It's truly a high PE ratio. Now, why would that be? Well, I just got finished saying this is a high-quality company. You have a very strong above-average return on equity. 17% would be above average for the S&P 500. You have above-average gross margins, and you have above-average growth. So what's happening is the market has realized this is a high-quality business, and so you're going to have to pay up for it. I mean, you see the revenue has grown, 2.5 times over the course of the decade from basically $2 billion to $5 billion. Very strong growth. So you like to see that. And your earnings per share have almost tripled. I mean, you've gone from about a little over $2 a share to $6 a share. Anytime you're tripling in a decade, that's a really strong mark to hit. You start to hit that when you hit that like 12 to 13% EPS range. So you really like to see those numbers. And so basically what's happening is the market has realized this is a high quality company. It's growing at a good rate. It's a company that you'd like to own. And this would be a business that would be very attractive from my watch list standpoint, simply from what we've seen here. Where I would think, though, about putting on like a watch list versus an instant buy is just that this PE is high. Now, it can justify this PE if it continues growing like this for this foreseeable future, but it's harder to predict that. I'd be a lot more comfortable paying a PE of 20 or let's say we cut it in half, a PE of 17. A PE of 17, price of $100 a share starts to get very, very attractive because now we can say, hey, I have a PE of 17. That's an entry multiple, entry earnings yield of 6-7%. That's a good number to hit at. And then you're growing double digits. It starts to get really, really attractive. I like that as a better entry point. Now, you are paying dividends, so you don't need all of your return coming from that growth, but you do see that, starting in that 2018 year, the dividend was frozen, and again, I'm guessing it was just related to that data breach and some higher costs that they've had since then. Now, if you're enjoying this video so far, hit that like button. Don't forget to subscribe, and at the end of this video, I'm going to link to a playlist covering all of the watch list companies that I have found, and these are my favorite companies in the S&P 500, so stay tuned for the link to that playlist. Now, let's go to the income statement next. Now, you can see, again, this big gap between revenue and cost of goods sold. That's always a good sign. One of the things you definitely see here is a big jump in SG&A in 2019. That's what's causing this operating profit loss. And then it comes back down in 2020. So maybe this was big, advertising. But this looks like one-time expenses to handle the problems that they had with the business. Now, it has adjusted down to be higher than it was prior to 2018. But it's still at they took off $600 million in operating expenses, so they were able to fully recover kind of that business problem. And they've actually been able to grow faster than normal over the last 2 years, and so the recovery looks really, really nice from the problems they started having in 2018. I mean, you basically had a 50% drop in your profitability there. That's because your operating expenses went up significantly while you had a down growth in gross profit. Cost of goods sold went up. So basically, this is a huge amount of investment that they had to make over a 2-year period to cause this. And what you can see is, I don't have a concern about this year of loss or about this investment because they've been able to recover from it. They've been able to tone down those costs afterwards, and the business is continuing to grow in a very nice rate. So there's nothing concerning there to me. Also, you can see the net interest income is only about 10% of your operating profit. So that's, again, a very nice amount of leverage because they're able to get that, 9% return on invested capital up to a 17% return on equity with only investing about 10 to 15% in interest. That's a really nice number. Now, at higher interest rates, this number will rise, but it's at a very nice level for shareholders. One thing I note here is basically your shares outstanding are flat over the course of the decade. This is neither really good nor bad. It's just an observation. What I like is that you're not growing your shares outstanding. There's not a lot of dilution, but I would like some buybacks here as well. Could be really, really nice. But they don't seem to have that for you. Now, let's look at the balance sheet. One thing you can see is there's very little PP&E. I mean, you can see, let's go to 2017, 567 million PP&E, and they had over 567 million in operating profit, or they basically had, 100% return on capital of the tangible capital. So this is a very non-capital intensive business. All of these return on capitals being lower is due entirely to goodwill and intangible assets. I mean, you look at this in 2021, they have, 8.2 billion of their assets are intangible out of 11 billion. So 70 to 80% of their assets are intangible. That's just telling you that they've made acquisitions. They've had to add that on the time. They've invested in intangible assets. But the overall underlying business is extremely profitable on a capital basis. So that makes it even more attractive as a high quality business. It's not taking a lot of capital. The only reason that it's even showing as having a lot of assets is because of the past acquisitions that they have made. And another way to look at that, I mean, this business is being run basically without equity. I mean, you look at the long-term debt. You have 4.4 billion in long-term debt. Now, if you take 4.4 billion and you subtract it from total assets, then you're going to have, 7 billion. But you have more than $7 billion in intangible assets. And so what that's telling you is your total liabilities, or just your long-term debt, is higher than your tangible assets. Now, with some types of companies, that would be a major concern if they're not stable, if they're not reliable. But with a company like this, that just shows how reliable it is, that the business managers are willing to leverage it up to a degree that there's no net tangible assets. There's actually negative tangible assets in this business. And that's actually attractive from a shareholder because it means you're not having to use your shareholders' equity to grow. You're basically being able to fund the entire business cost with debt. Let's go to our cash flow statement. A decent amount of depreciation here that's being put into investments, and I guess they've been having to do some investments the last few years, so that's a little bit more concerning than you'd see otherwise. But I mean, a lot of this is because of probably these acquisitions. I mean, pretty big acquisitions going on, $1 billion here, 1.7 billion here, 3 billion here, 2 billion here. So you see those numbers kind of really adding up over time. You see again, though, basically it looks like your stock buybacks are somewhat offsetting stock-based compensation. I don't really like the stock-based compensation, but because they're not diluting you over time, that's acceptable. But I mean, one thing that you notice when you look at this is we said that your stocks outstanding were flat over time. But look at how the money spent on buybacks, 85 million, is 2 to 3 times your stock-based compensation, 28 million. And then 38 million here, but you bought back 300 million. You bought back 200 million. Bought back 30, and then it was 38. So what this just tells you is that this number understates the real expense of issuing those shares because it's costing you more in the market to buy them back. Totally legal and legit. It's just the way that the accounting works is you're going to see an understatement in the stock-based compensation. So it could be that their net income is slightly overstated on that look-through basis. Nothing concerning there, though. Pretty reasonable. You see they have a lot of room here for more cash to be paid for dividends, though, if they are able to slow down these buybacks at point. I think they're probably building up some cash. Yeah, you have seen the cash grow over time. Hopefully they'll get better about sending some money back to shareholders, but overall, everything here looks really good. So, Equifax. I like this company. This company would go on my watch list. They have very strong returns on invested capital, returns on equity. This is basically operating at 100% return on tangible capital. That's an amazing number to see. It's very rare. In addition, you're able to combine that with double-digit growth. I always am interested when I can see a company growing 10% or more. The only downside, I think, is my current price. I'd like it at about half the price to start getting really, really attractive potential. Because what I don't like is the potential for declines in the PE ratio to offset the growth in the business. And that's where I can kind of see the potential risk here. And you can't predict that. So for me, that's exactly what would go on a watch list. You say, hey, this is a great company, good growth, strong returns. I like everything I'm seeing here. No big red flags, but it's on the watch list because you'd like to get a slightly better price. If you enjoyed this video, hit that like button. Don't forget to subscribe. We're working through every company in the S&P 500. And at the end of this video, right here at the top, we have a link to my playlist where I've covered all of the watch list companies that I think are the best companies in the S&P 500. I hope you'll check those out. These are my favorite companies that I've covered so far, and it's continuing to grow as I work through all 500 S&P 500 companies. And if you like this type of analysis, if you want to learn how to do this yourself, then I encourage you to check out quickfs.net. The affiliate link that I have is the first link in the description below. Please use my link to sign up. You can get a free or a paid account where you can use this software to analyze companies in 5 to 10 minutes, just like I'm doing here. I think it's a great service. I don't recommend anything that I don't use myself, and I use this to analyze companies. I hope you will check it out. Thank you for listening, and until next time, stop paying fees, start building wealth.